As accountants and financial executives, there is probably little reason to remind you, leasing is an important and widely used financing solution. After all, it enables businesses to access and to use property and equipment without incurring large cash outflows at the start. Of course, leasing also enables companies to address the issue of obsolescence and the risks of residual value. In fact, sometimes leasing is the only way to obtain the use of a physical asset that is not available for purchase. Under existing rules, lessees account for their lease transactions either as operating or as finance leases, depending on a series of complex rules. In practice, these guidelines used bright line tests, which could result in all or nothing being recognized on balance sheets for what are economically similar lease transactions. The business world began to change earlier this year when the International Accounting Standards Board published a new Leases Standard, IFRS 16, which comes into effect on January 1, 2019. Since virtually every company uses rentals or leasing as a means to obtain access to assets, the new standard will have an enormous impact on companies that do business in the more than 120 nations and reporting jurisdictions that permit or require the International Financial Reporting Standards as their generally accepted accounting principles.
With us once again is Dr. Peter Chant, who provides us with expert commentary on financial reporting matters, particularly those involving the International Financial Reporting Standards. Peter is past chair of the Accounting Standards Board of Canada, and some viewers may recall his book, IFRS for Canada, drawing upon his experience in helping companies make the transition to IFRS. Thanks for joining us this month, Peter.
Thanks, Mike. It's nice to be here.
You and I have discussed the development of a new standard on accounting for leases for the past decade. Is it true that there really is a new lease accounting statement?
Yes, after approximately 2 decades of work, there are statements out on lease accounting that substantively changed practice from both the ISB and the FASB. So I must admit, I was not always optimistic it was going to happen, but it looks like it has.
Over the years, Peter, you've told me about other accounting standards. And one of the things that I've taken away from our discussions is that on paper, accounting standards often sound good, but the devil may be in the details.
Well, I think that's why it took 2 decades to cook this stew. I think there are some inherent issues with leasing by its nature, and that is you're basically taking a physical property, subdividing it either by a strata of time ownership or physical ownership. You're making part and parcel of a larger being. That's going to bring in legal technical difficulties to start with, plus a lot of practice had grown up to exploit the attributes of the current standards, which distinguish between operating leases off balance sheet and finance leases on balance sheet, and those practices, and trying to make sure that you captured those attributes, I think made it take quite a bit of time. But I think it's there. I think the standards are there. They appear to be operable. They may not be popular, but mission accomplished.
You keep saying they, Peter. When we first started discussing lease accounting, you told me that there was going to be convergence between the IFRS standards and U.S. GAAP. And later on, you told me there was going to be harmonization between the standards of the International Accounting Standards Board and the U.S. FASB. Well, where did we end up?
Well, that's interesting that you bring up that convergence to harmonization to 2 standards that are kind of close friends but not identical, that's for sure. And that's the FASB standard, ASC 842, and the ISB standard, IFRS 16. They both share the same general principle, which is generally all leases of any substantive nature are going to be capitalized and put down as obligations on the right-hand side of the balance sheet, and there's going to be an asset showing up on the left. After that, the implementation details, even as far as things like the cash flow statement, diverge significantly. So while the general principle has been, I'm going to say, effectively harmonized, the end result, if you want to call that details, I would call it practical application, is somewhat different.
Let me follow up by asking you, what about the U.S. company with a mining operation in Canada, or the Canadian manufacturer with an assembly line in the U.S.? Now remind me, Peter, how do businesses in general determine whether they report under the international standards or under U.S. GAAP?
Well, I think for the most part, those choices are pretty well dictated by the regime under which they report. But there's going to be essentially a large number of enterprises that are not going to have much of a choice or already chose that they are going to report under IFRS and they'll stick with the program. There is a class of Canadian company, regulated utilities in particular, who have not adopted IFRS, even though that's generally the standard framework of choice in Canada, and have, essentially for competitive reasons, elected to adopt U.S. GAAP. Now, the FASB, in amending its leasing standard, did pay particular attention to regulated utilities. So it has made some specific provisions. And those Canadian companies who have elected to follow U.S. GAAP on that matter are going to be impacted by that.
Well, one of the first questions on this topic that you or the standard setters are bound to get is, what is a lease? I mean, sometimes aren't companies providing services that look an awful lot like leases?
I think that's a case where business practice has migrated even during the gestation of the standard. I think originally anybody who provided an asset to another party was going to lease it, and that was pretty cut and dried. I think what has happened in the meantime, for a variety of reasons, many of them being bona fide business reasons, the leasing industry, at least some part of it, has morphed into a service provision industry. I think of information technology being a big one. Computer leasing, CompuLease, that was a big industry. But now it's morphed into providing information technology services where, in many cases, it isn't stipulated what it is in terms of the physical assets that are provided. There are terminals. There have to be input devices, and it's probably the service level agreements stipulate they must have certain attributes. But their nature and kind and physical type are probably not stipulated other than they must be able to process a certain amount of transactions in a certain way in a certain unit of time. The computing power, again, would not be stipulated in terms of a specific mainframe, but in terms of transaction cycles and delays and the ability for customers to retrieve documents and also things like downtime. But additionally, there would be a continuous service improvement commitment. That is, you wouldn't be provided with a software package. You would be provided with a commitment for customer service levels, and the software would continuously improve. So even the notion of ownership and transferring ownership, I think in those circumstances is somewhat irrelevant, because now we look for a continuous improvement in service delivery. So I think what we used to think of as leasing being the transfer of assets, in many cases has morphed into leasing as a transfer of services. And I think as operating leases in particular, as we know them now, get on the balance sheet, there will be circumstances where both the lessee is going to say, well, wait a second, if it's on my balance sheet, this is debt, then it's expensive debt. And there may be a different way I want to finance this. So I'm not sure I'm that interested in leasing anymore. The lessor reacting to this is going to say, well, maybe our business model has to change. Maybe instead of being a bricks and mortar or chips and keyboard provider, we're going to have to think a little differently, think of our customers' needs, both in terms of the financial statements, where they don't want an obligation if it's avoidable, and in terms of what it is that I'm providing. I don't want that truck. I want transportation services that will meet my needs. And as technology marches on, I want to share in that. I want to be at the forefront of technology. I don't want to be locked into some technology that you transfer to me. I want to progress in that parade too. All these forces, I think, are going to ask the lessors to think differently and the lessees to react differently to the offers. That's almost independently of the standard, but certainly capitalizing leases is going to add additional impetus to lessors and lessees to change what they're negotiating.
Thank you, Peter. We'll return to your commentary in a minute.
As Peter Chan indicated, IFRS 16 includes detailed guidance to help companies assess whether a contract contains a lease or a service or both. And similar to prior guidance under IAS 17, the scope of IFRS 16 generally includes all contracts that convey the right to use an asset for a period of time in exchange for consideration. In other words, a right of use accounting model essentially replaces the risks and rewards model. As a result, lessees will now be required to recognize an asset and liability at the inception of a lease. This means that lessees should initially recognize a right-of-use asset and lease liability based on the discounted payments required under the lease, taking into account the lease term as determined under the new standard. Of course, determining the lease term will require judgment that was often not needed before for an operating lease, as this did not change the expense recognition. In determining the lease liability, both the direct costs and any restoration costs are also included. While the definition of a lease is slightly different from the current rules, many of the exceptions to the guidance remain the same, including 1. Licenses of intellectual property granted by a lessor. 2. Rights held by a lessee under licensing agreements such as films, recordings, patents, and copyrights. 3. Leases of biological assets. 4. Service concession agreements. And 5. Leases to explore for or use minerals, oil, natural gas, and similar non-regenerative resources.
A few minutes ago, Peter, you used the tangible property of computers in your example of products that are leased. But what about what's contained inside those computers? To what extent are intangible goods, or so-called intellectual property, also covered under the new leasing standard?
I think intangibles are fascinating. I've myself have done a lot of work on royalties in mining, which in essence are subdivisions of property interests in natural resources, but they apply just as well to biotech and to literary works, where you actually subdivide the economic interest rather than the physical asset. And for upfront payments, you get a participation in the economic benefits. That's the same thing you get when you lease a physical property, at least an office building where you're renting location. It applies just as much to IP, I believe, the concepts there. Unfortunately, the accounting standards tend to shy away from that. Although in the United States, there's a rather well-developed literature on bio and pharma royalties, because those arrangements can be manipulated in certain circumstances. But in general, they are not covered mandatorily by the new ISB standard on leasing, but it is an option to use the new leasing standard to apply to IP.
Over the past few months, I've heard it said that the new lease accounting rules will have a greater impact on the income statement under IFRS than it will have under US GAAP. If you don't mind, I'll ask you two questions. Is this true, and what does it mean?
Well, the income statement is significant. What's going to happen, and one has to be very careful with one language here because the standards diverge. This is where they diverge in a subtle but significant way. Under the ISB model, which is pretty straightforward, the obligation to make payments for the use of property will be capitalized. That essentially creates the starting value for the asset, which is now called a right to use. And that asset will be depreciated, as with property, plant, and equipment under the relevant standard IAS 16. And essentially, what will then happen on the cash flow statement is that what used to be expensed as a operating lease expense, the payment for the property, will now be taken out of operating expenses and called a financing transaction, where it's paying down the obligation. So the operating cash flows, ceteris paribus, are now going to be increased under the IFRS 16 approach, because a non-cash expense depreciation will replace, and interest, I got to point out, which is still cash, will replace the cash lease expense. And in the cash flow statement, the cash lease expense will be taken out of operating and put in financing. That's a pretty big change. Not so under the U.S. model. I think intuitively one can say the FASB felt either uncomfortable, either intellectually or perhaps politically, or perhaps both, I think there's a bit of both. In taking lease payments and really recategorizing their nature from operating to financing. I think there's still a lot of intuitive sense in that one pays for office rents, for example. And so that has a flavor of more pay-as-you-go than financing and borrowing and investing in an asset. And I think the FASB came to the conclusion that operating lease model, where yes, we will expense the amount as depreciation. Yes, we will take that right to use asset, which we've created along with the IFRS, but we're not going to reclassify the cash flow payment. That's still going to be operating. So there's going to be no relief on the operating cash flow statement from this accounting recharacterization of the lease payment as the creation of an asset and the setting up of an obligation. And cash flows are a big deal. Operating cash flows are focus of analyst attention. Certainly, the IASB would feel that the way they've recharacterized leases as financing with depreciation expense and the interest from unwinding the discount on the obligation is conceptually true and consistent with everything else. But I think the FASB model, where essentially the expense is going to be the same as it was under the operating lease model and the cash flows will remain similarly characterized, has a flavor of what you call it realpolitik, which is this is a little more realistic as to the substance of the arrangement. Now, there are cases when that's probably a reach. There have been many well-constructed operating leases which have been designed to meet the 89.9% threshold, but not the 90% threshold of a capital lease. And some of those, it's difficult to see why the IFRS model is not appropriate. But in many cases, car leases for relatively short terms, other elements of technology, I can be more sympathetic to the U.S. view.
You've told me that the new requirements eliminate nearly all off-balance sheet accounting for lessees. Won't this have a significant impact on most of the commonly used financial metrics, such as EBITDA? And couldn't that affect loan covenants?
That's interesting. I think there's obviously a wide range of loan covenants, from covenant-free debt to highly structured, highly secured. I'm going to call it cash flow tests or synonyms to cash flow tests based upon EBITDA. And that's where that's going to be interesting, because EBITDA generally adds back depreciation but does not add back operating lease expense. I've investigated that topic, and in many cases there is no discussion of operating. So now that we recharacterize that property as a right to use and depreciate it and call it depreciation expense, EBITDA will go up. So there'll be some relief in some covenants drafted that way. There's other covenants that focus on times interest earned. And any increase in interest expense, such as which is expected to happen under the IFRS standard, is going to challenge a lending covenant that has a times interest earned measure where the interest expense goes up and there's no other change in the denominator of such tests. So another case where the two models have the same implication for the financial statements is in the measurement of current assets and current liabilities. Now, this would not necessarily seem directly relevant to leasing, but once we capitalize a lease obligation, there is going to be a disaggregation of that obligation into a current portion due within a year and a long-term portion. And that current portion is going to show up in current liabilities without any similar reclassification of assets. So, ceteris paribus, there will be a reduction in net current assets, an increase in current liabilities, because under operating lease treatment, as currently practiced, generally there's no accrual of the operating lease payment. It's just paid, never hits payables, it's just in and out of the cash. Whereas once we've capitalized the obligation, there will be a change in current liabilities. And I've worked with some retail lessees of property who manage their financial affairs quite tightly. And to them, their biggest concern was this change in the current ratio, because many treasurers do manage that ratio and the availability of funds very tightly. And this significant increase in liabilities is going to mean a pretty big change in the way they manage their cash. That, I don't think, was always anticipated. It is showing up as a discussion element in the professional literature. But I'm not sure that all lessees, particularly of office space, have realized that a lease of an office for 4 years is going to increase their current liabilities.
As Peter Chan indicated, the new lease accounting standards will affect virtually all commonly used financial ratios and performance metrics, from current ratio and EBITDA to net income and operating cash flows. And based on feedback provided to the IASB on cost and benefits, the board decided to exempt 2 categories of leases from the complexity of IFRS 16. Under the new standard, lessees may elect not to recognize assets and liabilities for leases with a lease term of 12 months or less. In those cases, a lessee recognizes the lease payments in profit or loss on a straight-line basis over the lease term. In addition, lessees are not required to recognize assets or liabilities for leases of low-value assets. The board indicated that an amount of less than $5,000 when new would normally qualify for the exemption. As a result, you could decide not to account for many leased items, such as tablets and personal computers, small pieces of office furniture, and telephones under the new standards.
Well, in connection with low-value items, the IASB certainly was considerate of their users and our viewers, weren't they, Peter?
There's good news and bad news, Mike. There's the IFRS approach, and I think the IASB felt that they didn't want to create nuisance accounting here, because there are a lot of leased items that are leased simply because they are nuisance items. Nobody wants to maintain a cell phone inventory when they can be leased and thrown back at a lessor for next time the revolution comes and you need a better photograph. There are photocopiers everywhere in the universe that are generally not very expensive, often held under lease, partially to make sure you get the latest technology and you're not tied into some ancient creaky machine. There are laptop computers. The technology constantly changes. Every salesperson or professional needs one. There are gazillions in organizations. They're often hard to take a hold, get track of. But frequently, these are also held under lease. Now, technically, I can see where for some organizations, I think of professional services firms. What do they have? Office leases and laptops and a bunch of employees. The laptop may be the biggest asset on their balance sheet when they capitalize it. And, that could be more than a couple years lease, turn them over, a lot of software in there, internally developed, which is a related but somewhat different issue. The IASB's approach is to try and detrivialize this issue by saying that low-value items do not have to be included in the standard. And they didn't specify what low value is. The number $5,000 is kicked around. I find that interesting. Is that translated into 6,300 Canadian dollars or euros? How many euros? That depends upon the day, perhaps, as to what that means. But I think they were looking at that threshold of transaction size where enterprises are somewhat indifferent in the normal course of business between expensing and capitalizing. And that there's tax practice that governs that as well. How you need to depreciate that. Can you have to put it in the pool, or can we just expense it? So the IASB explicitly recognized that low-value items, as measured by the item, not by the materiality to the organization, are out of scope, as well as leases less than 1 year. The FASB did not include a low-value item exclusion. I can hear the argument in my head is you may have a couple $100 million low-value items and you have a material amount, and I don't care if it's $1 or $5,000. times a million, you've got something that is possibly needs to be accounted for, and we cannot make generic statements. So there was a different compromise. I think it's an interesting contrast in standard setting styles that the ISB did not compromise, if you want to call it that way, on the cash flow issue and recharacterize the cash flow, but did offer a low value item exclusion. The FASB, on the other hand, did not offer a low value item exclusion, but did not change the cash flow characterization.
Now, I'm curious, Peter, to what extent might private companies be interested in adopting this leasing standard?
Mike, that's a good question, and I'm glad you phrased it the way you did, because interested for their own financial reporting purposes, unless they're contemplating becoming public companies, is probably a low-level activity. I don't see why anybody would want to go away from the cash basis accounting as currently applied for many leases. On the other hand, we've already talked about the way that this standard might change the attitude of lessees. And you may be a private company, but you may have public companies as customers or as competitors. But if they're customers, it is quite possible that a lessee is now going to reevaluate the benefits of acquiring assets in a leasing mode or acquiring the services of assets in a leasing mode as opposed to just buying it themselves, or maybe just outsourcing the entire activity to a service provision arrangement that doesn't necessarily have any financial statement consequences that are different from the current model. I think a private enterprise has to consider its customer base as well as its intentions of going public, and should ask themselves if the service they provide is going to be affected by the new standard, and see if they should have to rethink the competitive terms of both the services and the pricing they offer. The other thing I think private companies may have to do is consider the fact that if they're in competition with public companies that are now going to be capitalizing and coming up with different EBITDAs, coming up with different ratios, coming up with quite possibly different times interest earned metrics, coming up with different leverage, I think that they might want to compare themselves, and it's not always going to be a negative. As I've said, the reclassification under IFRS of some cash flows out of operating into financing will make some public enterprises that do that look like they're having very healthy increments in cash flows. And that may also be a particular result of the way this standard is being implemented.
Oh, you know our viewers, Peter. So let me ask you, what should financial statement preparers, whether it's under IFRS or GAAP, be doing right now?
I think they're reasonably close, but I think it's not the transition that's going to make the difference. It's the substantive difference in the standards. After one gets over the cash flow differences, which I consider to be the big deal, I think I'm not going to say the rest are trivial, but I don't think they're quite of the same consequences. There is going to be, as I said, some impact on ratios that particularly affect lending. And if you've got debt covenants, those are the ones that I'd be thinking of way in advance, particularly if you got a chance to amend or adopt or renegotiate or let an option expire. An option that you might have said, well, actually, I'm pretty certain I'm going to take that renewal option. But now when you look at the financial statement consequences, you're thinking, well, this may not be as good a deal as we originally thought. And funding it with a different mix of debt and equity is going to give a different dynamic profile to our ratios. And it may change our current ratios and may be a little more copacetic with our covenants. And one of the things the IASB has done is allowed enterprises that are implementing it to simply start at the beginning of the year and capitalize all the leases that are present on their balance sheets and not recast the prior year's numbers, which is going to make for one-time changes due to accounting principle changes in the year-to-year results. those year-to-year results, particularly in cash flows, may suggest that the company has had some watermark event there, watershed event that has significantly increased their operating cash flows, when in fact it's just a reclass. There's some strategic thinking that has to go on there, because going backward to apply the standard means you would go back into a high interest rate era where the discounted cash flows may end up to be different and the interest expense different than it would be under the one-time change approach, which is allowed at least under the ISB standard. So I think the important part for both preparers under IFRS and under FASB is thinking ahead of what you're going to do in the next couple of years before the implementation of the standard, so that you can take all those steps that you could make to make the best result when you do change. So I don't really think it matters too much about the standard. What I think matters is what you're going to do between now and then.
This would be a lot of work, even if accounting for leases was the only new financial reporting standard that needs to be implemented. But you know, Peter, that both standard setters have also approved new guidance on revenue recognition. To what extent should companies, or must companies, implement these rules at the same time?
Well, that's an interesting question, Mike. The short and sweet answer is you must implement the revenue recognition standard, revenues with contracts from customers, before you implement the leasing standard, partly because these two standards were developed together and there are cross-references in the leasing standard to the revenue standard. The sale and leaseback criteria, the sales type lease criteria, and several other criteria just simply reflect the revenue recognition criteria. So you must implement the revenue section either coincidentally with or before you implement the leasing standard. I'm not sure what I'd recommend. I'm not sure you'd want to go through hell twice to implement the leasing standard after you've spent all the time getting up the curve on the revenue standard. But yeah, it's going to be a lot of work. But as I said, there's a lot of cross-references, so there may be some merit in doing both at the same time, although if you need to get your contractual ducks organized because of the implications of the leasing standard, which are different, and there's different actions you can take, then I can see why an entity would delay.
Well, if our viewers could take one thought away from this program about accounting for leases, Peter, what would you like that to be?
Well, Mike, the takeaway here is almost, this is the price of inevitability, the thought that leases are obligations and belong on balance sheets, that every airplane up there flying around, which today maybe 50% of them are flown under operating leases, maybe we ought to get real and put assets and liabilities relating to those contracts on our financial statements and make them more relevant. This is an improvement that's been asked for a long time. It's been thought about for 20 years. There is a sense of inevitability about this. Now, I think, yeah, there's going to be a lot of investment necessary in the next couple of years. You're going to have to do a lot of things, rethink your customer relationships, rethink your deliverables, rethink your pricing in some cases. Definitely have the accounting department go up the curve a bit on business practices and be more integrated with the organization, because the last thing you want is a negative result that could have been prohibited by better behavior. The only good news I see is this was the last, leasing in particular, and revenue recognition, of a long line of items that were not very well converged and harmonized at the beginning of the 1990s. There were vast differences in standards. We are not perfectly harmonized. We did not converge. There is no question between U.S. standards and IFRS standards. But when I look at the difference between practice globally versus the United States, 1995, practice globally, financially, United States, the rest of the world, 2015, it has been a huge improvement. There is a lot more harmonization and convergence and comparability. That can only be seen as a good thing.
Peter Chant, thanks for bringing us up to date. Great to see you again.
Mike, it was great to see you again.